You had said in the last day or so that there were many companies like Apple that could be hurt because of these trade tensions. But Larry Kudlow, the chairman of the National Economic Council, or the director of the National Economic Council, came out and said there aren't that many companies. So are you and Larry on different pages here?
No, not at all. But the fact is, this could happen in an interview, that there was sort of a second half of a sentence, which I really should have added when I responded to the question, is Apple the only company that's affected by the slowdown in China? The answer is no. There are a heck of a lot of companies that are affected. But you have to remember, to put it in context, that the Chinese share of U.S. profits is only about 1.7%. And so even if Chinese profits went to zero, which no one expects they're going to do that, it would still be possible that next year we'd be revising up earnings estimates because GDP growth is so strong.
Broadly, though, do you see trade tensions? You have an aggressive 3%, that's my word, aggressive, 3% GDP forecast for the U.S. this year, which is high relative to the street, 7/10, maybe a full percentage point. Do you see these trade tensions detracting from growth this year?
Well, I think that the strong growth that we had this year basically happened while the trade tensions were rising, right? Like the tariffs were being put in place and so on. And I think that looking ahead to this year, what we expect is that we're going to, as we have with the new NAFTA, USMCA, with Korea, conversations with Europe, that with the Chinese, that we're going to move forward and actually reduce tensions throughout the year. And so I think that because, the uncertainty about our trade progress last year was a negative and we still grew 3%, it should make you, Steve, more confident that we'll get 3% next year.
I welcome your optimism, Mr. Hassett. But I think markets also seem to be inclined to believe the worst here. If that does not happen, would you think that would subtract from growth?
If we don't make positive progress in reducing uncertainty about trade, it would subtract from growth, yes.
Let me talk about another thing where I think the market and the administration are on different pages here. It comes to capital investment. And I know you just gave a very wonky speech right down the hall here with words like endogenous and ex ante in your slides, but we're not going to do that here. What we're going to talk about is there's been, in some of the data, a decline in business investment that has made some skeptical. Two things. One is that we're not getting the capital investment rebound. And the second one is that this year, we're not going to see the better growth that we got from the tax cuts last year in either earnings or the economy.
Right. I think the way to think about it is that suppose that what you're doing every year is you're just buying enough new machines, if you're running a plant, to replace wear and tear. Right. Well, then the plant isn't really growing, right? And so that was pretty much the world that we were in when President Trump was elected, that in the aggregate, that there was actually more depreciation than there was buying of machines. And so our productive capacity was actually flat to slightly down. But suppose you go from doing that to, buying a whole new plant this year. Then now all of a sudden, instead of having one plant, we have two plants, and we have a lot more output, right? Suppose you buy another plant next year. Well, at that point, since we bought a plant this year, then you would say, investment's flat. But we're adding a whole new plant. So you'd have three plants if you bought a whole new plant next year, because investment is the thing that makes capital grow. And so what should happen after a tax reform is investment should jump up, and then it should grow back at trend from that higher level. And so, we expected forever and ever investment would go up about 10% this year and then kind of return to trend. And while it's doing that, productive capacity will continue to grow over the next decade. And so the presentation I just made here at these meetings showed to a whole bunch of wonky economists a bunch of slides that showed that the investment spike that we predicted happened almost exactly at the scale that we predicted.
But if you take a step back and you look at what the market seems to be forecasting here, which is somewhere, maybe it's a recession or it's somewhere just north of a recession. Is the market missing this story about the continuing benefits of the tax cuts this year?
The market's a very smart thing, and there's a lot of stuff going on with markets for sure. And so, it could be that, our story for why the market did something is completely wrong because I'm in the Milton Friedman School, the market's very smart. But the fact is that when you look at the core data, the GDP in the fourth quarter, our internal models have it just about at 3. We've just had about the strongest jobs report we've had in the last couple of years, with the big upward revisions to previous months. We're heading into next year with a massive amount of momentum and tax cuts that basically, as per my presentation, which you can find at the CEA website if you're watching and like to see it, that just showed that tax cuts worked just the way we said they would. And so think about it this way. Last year, you and I talked about it, I can remember, about my outlook for this year, and I said 3.1, and you're like, oh, that's way above consensus. It doesn't make any sense. And then now it looks like almost exactly we're going to get 3.1, depending on what happens to the fourth quarter. And so the model that said 3.1 this year says we're going to be about that next year too. And now we've got one whole year where we were correct. And so why would I revise downward after giving this controversial forecast that turned out to be correct? So I should actually
I like that,
be more
doubling down. And I'm more on your side now, Kevin. But I have a question for you. In your experience of the data, do we stop on a dime? In other words, can you go from 3 to below 2 or below? I mean, my experience is that it doesn't happen that way. Is that there are slopes to these things, and that you don't go from 300,000 to negative job growth, or from 300,000 to 100,000. Is that so? Do you think the market's overdoing it here in terms of its pessimism?
There's a big literature on this, and one of the things that has been shown to be a useful indicator that definitely got some problem with, or caused some problem with markets, is the yield curve. When the yield curve inverts, then that usually is a sign that there's a recession coming. But right now, I think the yield curve is a really difficult signal to read, because the back end of the curve is still being impacted by quantitative easing and so on. And so for me, I think that the only indicator that's ever worked in the past is in some sense a little bit obscured by global quantitative easing. And so I think that if a recession comes, I'm not sure the yield curve is going to signal the way it has in the past.
Kevin, this is the second interview we've had to do. The market's been up on both days. You did not know that before you came on, so I look forward to continuing the conversation with you.